Remember the NFT craze of 2021? Millions were poured into pixelated apes and cartoon rocks with everyone convinced they were the next Bitcoin. Or what about the electric car frenzy of 2020? Company valuations skyrocketed to dizzying heights, regardless of how many vehicles they actually produced. Unfortunately, the stock market is no stranger to these everyone's doing it, so I should too moments. Right now, we're seeing a similar rush into risky investment schemes that promise fast, easy returns. But as with so many viral trends, the shine tends to wear off quickly and people are left holding the bag. It's important to remember that the stock market isn't a never-ending party. Historically, when things get overheated like this, when everyone seems to believe they've cracked the code to getting rich, the crash that follows is often brutal. The revelers get bolder, the music gets louder, and at some point the cops show up and shut the whole thing down. In the market, that sudden party shutdown comes when investors realize that those sure-thing stocks weren't so sure after all. The scariest thing about these market bubbles is how quickly the mood can shift. Imagine going from everyone piling into that beach party, convinced the night will never end, to a scene of panicked people scrambling for the exits. It's the same dynamic in the stock market. One day it feels like prices can only go up. The next fear takes over and everyone's looking to sell before they lose even more. This sudden evaporation of confidence is what turns a market correction into a devastating crash. Don't be fooled by people saying this time it's different. From the 1929 crash to the dot-com bubble in 2000 and the housing meltdown of 2008, this boom and bust cycle is a recurring theme. The players and the trendy investments change, but the underlying truth remains the same. The market hates a vacuum. When there's too much greed and too little common sense, a spectacular fall is usually waiting in the wings. Remember the 2008 financial crisis? Banks getting bailed out, people losing their houses and retirement savings disappearing overnight. That crash was caused by reckless bets on the housing market with a whole lot of borrowed money. The problem is echoes of that same kind of reckless gambling are ringing loud and clear in the market today. In 2024, the market is like a sprawling bone, dry forest primed for an inferno. The sheer volume of money poured into risky schemes and speculative investments has ballooned since 2008. If a spark sets it off, a major company going under an unexpected interest rate hike, political instability, the fire could rage out of control. The really scary thing about major financial crashes is how quickly the damage radiates. Imagine a line of dominoes. When the initial domino falls, the stock market, it sets off a devastating chain reaction. Banks with huge market investments get hit, forcing them to restrict lending. This means businesses can't get the funding they need, so they downsize or go under altogether. Suddenly, unemployment spikes, consumers have less to spend, and the entire economy starts spiraling downwards. Imagine you've been diligently saving for retirement. Here's the problem. Even though safe investments are ultimately tied to the stock market's performance, a major crash doesn't discriminate. It can send the value of your retirement savings plummeting, leaving you scrambling to make up the difference just when you should be planning to relax. Picture this, the stock market starts going haywire, companies panic, investors yank their money out. Big businesses start laying off workers to cut costs. Your neighbor loses her job. Your cousin's small business goes under. It becomes an infectious cycle. People with less money spend less, which hurts other businesses, leading to yet more layoffs. Suddenly, finding a job, any job, let alone one in your field, becomes a nightmare. For many Americans, their home is their single largest investment. But here's the sobering truth. Home values are closely tied to the overall health of the economy. During times of market turmoil and economic downturns, housing demand decreases. If you need to sell your home in such a climate, you could be forced to accept a much lower price, erasing years of equity. If you were planning to use your house for a reverse mortgage in retirement, that plan might go out the window too. A healthy, stable market is essential for a healthy, stable economy, which affects job savings and the fundamental security of anyone working and planning for the future. Picture inflation as a relentless monster wreaking havoc on the economy. When prices for everything, groceries, gas, rent, keep rising, it causes a whole ripple effect of problems. Businesses start seeing their costs go up, eating into their profits. Meanwhile, people on fixed incomes like seniors living on Social Security see their buying power shrink. While inflation in 2023 and early 2024 has cooled down a bit, it's still lingering stubbornly higher than the ideal target. Imagine a company as a big machine with lots of moving parts. In a healthy economy, all those parts are greased and working smoothly, delivering solid profits. That's what makes stocks attractive to investors. However, right now we're seeing several of those machine parts starting to seize up. The rising cost of borrowing money due to interest rate hikes eats further into their bottom line. When profit margins shrink, companies become less attractive investments, which spells trouble for the stock market. Economics isn't just about charts and statistics. It's about how confident people feel about the future. When everyday people are worried about making ends, meet worried about inflation eating into their savings and worried about the job market, they stop spending their money as freely. Think of it like everyone hits the brakes on the economy when they're nervous. This sudden slowdown spells disaster for businesses, which leads to layoffs and a downward spiral. Sadly, surveys show that consumer confidence in 2023-2024 has been shaky at best. No one has a crystal ball that can accurately predict the exact timing of a stock market crash. But when you see these warning signs converging like storm clouds, persistent inflation, shrinking profits, and widespread consumer anxiety, it's foolish to ignore the risk. Think about it like this: if you see dark clouds amassing you, grab an umbrella and seek shelter. You don't wait for the downpour to begin before scrambling for cover. The same logic applies to the market. The smartest investors don't try to perfectly time the bottom, but instead focus on protecting their finances when they see clear indications of a storm brewing. You know how some songs have a hypnotic effect, luring you in with deceptive sweetness? In the stock market, there's always that siren song playing in the background. This time it's different. This boom will go on forever. Unfortunately, these voices tend to get loudest right before everything crashes. Don't let their catchy tune lull you into a false sense of security. Investors who claim that this time it's different haven't been paying attention to history. It was railroads in the 1800s, tech in the 1990s, crypto in the 2020s. But the underlying pattern of human behavior stays remarkably consistent. Greed over confidence followed by a brutal reality check. The booms and busts have played out repeatedly over centuries of financial history. Anyone claiming we've somehow transcended this cycle is either dangerously naive or intentionally misleading. Ignoring the warning signs is like refusing to wear a seatbelt because you're a careful driver. The market doesn't care how responsible or hard-working you are. When a crash hits, it hits hard. Being proactive in a shaky market isn't about panicking or making rash decisions. It's about assessing your personal risk tolerance and taking sensible, measured steps to protect your financial future. Here's where those actions make the biggest difference. Retirement savings are if your nest egg is heavily exposed to the stock market. Even a moderate downturn can seriously jeopardize your plans. Short-term needs are if you need access to a large chunk of money in the next few years, a down payment on a house, paying for college. It's unwise to keep it in volatile investments. Peace of mind is knowing you've taken some precautions reduces stress, even if the market goes haywire. Protecting yourself doesn't mean giving up on investing or trying to time the market's every dip. It means building a resilient portfolio that suits your goals and your capacity to handle ups and downs. For many people, this might involve diversifying investments, shifting some funds into more stable options, or simply re-evaluating their long-term financial strategy. The goal is to minimize your losses during the inevitable downturns and still benefit from the market's growth potential over time. Remember, the stock market over the long run has always trended upwards, but those gains aren't delivered in a smooth, straight line.